of ARPG. I'm Garrett Lale. Matt, apologies again. You absolutely outkicked me on the hair today. I don't have any hair gel with me. I'm on a very short, like little 20-hour turnaround at my place. I've got to go back to my parents to help my mom when my daddy had surgery this week. So I'm not exactly looking my best. You've got me killed on the appearance, but good to see you as well. I'll keep me small on the screen today.
You look great. You're clean shaven. Looks like you're going to join the military.
Well, good story about that. So at the hospital the other day, my dad's nurse came in there and asked me if I was his brother. So that was my cue to ditch the gray beard.
Yeah, that's a tough one.
That one hit.
I got nothing.
Yeah, that one hit hard. We said that this was going to be the year of humility, I believe, like back in January. Hitting pretty hard.
Well,
not going to lie.
I didn't know doing the intelligence would age us so rapidly, but apparently it is. I mean, look at me. God, I look like Methuselah's grandfather.
Yeah. Well, good to see you as always, man. So what's going on in the world of Matt right now? So you and I had a cool talk yesterday, and I know you kind of gave me the rundown of some data points. And we've got this little tug of war thing going on again between the smart roommate and the goof off roommate, the equity market. So what's going on in the tug of war between the bond market and the equity markets right now?
Well, again, the bond market is, I think staying ahead of the curve like they always do. What's his name? Poindexter?
Poindexter, yeah.
Poindexter the nerd, right? He's not worried because all he cares about is data. And what does the data say? So if you look at the high yield spreads, right? Again, back to treasury bonds against bonds issued by companies with a lower credit quality, i.e. if the economy is going to go into recession, those companies that have poor credit quality have a poor credit quality for a reason and will have difficulty servicing their debt. Thus, their bonds reduce significantly in price because the market is worried about them being able to service that debt. So the yields jump up and it spreads and it widens the spread between treasuries and those bonds. And we like that number to be less than 6%. If it goes over 5.5 or 6%, we kind of start to give it some side eye, right? Once it gets over about 8%, we really start to pay attention. It's at 3.19. Okay, it's pretty darn low. It really never moved. It went up to 4.6 at the height of the tariff talk and the height of the recession talk in early April. That's the highest it ever got. Okay, so we're not seeing any sort of issues on the bond markets, but again, we're seeing poor sentiment, right? Poor sentiment readings, right? So there have been a few items, data points that have pointed to a little bit of sluggishness in the economy. Don't get me wrong. It's not all rosy as far as the hard data is concerned. The ISM numbers came out this week, both manufacturing and services. Okay. Manufacturing has been contracting for about 28 months, about 31 months almost straight now, which is the longest in history. It's at 48.5, and at 50, it's neutral. At 50.1, that sector of the economy is expanding. Okay, that's how the ISM number works. Same thing with services. At 50, it's neutral. At 50.1, it's expanding. At 49.9, it's contracting. So the ISM manufacturing number came out at 48.5, but that's actually up a touch. It's starting to curl up. We think it's going to head into expansion mode here over the next 3 months or so, which is a good thing. Okay, it's usually indicative of a new sort of economic cycle, which we believe is taking place. However, the services number came in at 49.9. It was down from 51.6 last month. So we had expansion last month, 49.9. So it was almost neutral, contracted slightly. Why is that important? ISM services, so the Institute of Supply Management, that's what ISM stand for. The services number represents 72% of our economy. So it's a big one, right? Mm-hmm. We are a services-based economy. So if that contracts, that's a pretty spicy meatball. You know what I mean? And it showed that it contracted just a little bit, right? But the job openings number came out this week, 7.4 million jobs available, up from 7.2 last month and a $7.1 million estimate, or 7.1 million consensus. So that's showing some strength in the labor, right? a little bit. We have a little bit more than one job available per person, which is a pretty decent ratio. They would like it to be about 1.05 to 1.1, right? But if it gets above 1.15 to 1.2, that's when the Fed goes, hey, inflation is going to start taking root, because when we have this many open jobs and only a certain amount of people to fill them, that's when wages go up, and that sort of starts to plant the seeds of inflation again. But we're not there. The jobs number came out this morning. Okay, the actual jobs, the payroll report for May came out today. 139,000 jobs were created in the month of May. The estimates, the Dow Jones estimate was 125,000. The consensus estimate was 130,000. Okay, so last month we had 177,000 that was posted, but that was revised down to 147,000. So we've actually only had 147,000 jobs posted, created in the month of April, and 139,000 for the month of May. And that may be revised down when the June number comes out beginning of next month. So what is that kind of telling us? I mean, if you take 2024 as a whole, right, the average monthly jobs created in 2024 was 168, 170,000 right through there. Okay. We're about 125,000 a month right now. Okay. So we're definitely seeing a cooling. Okay. We're seeing, the services number at 49.9. We're seeing some decent open jobs, and we have a pretty decent economy from what the bond market's telling us, and earnings are strong, and we're seeing the Atlanta Fed GDP tracker that was at 3.8% last week and this week. It actually jumped a % earlier in the week, and now it's back down to 3.8% for Q2. So what that number means is the Atlanta Fed tracker takes Q2 GDP and annualizes the number. Okay, and that's showing it 3.8% on an annualized basis, which is very, very strong. However, that's skewed because we have far fewer imports this quarter than we had last quarter, because last quarter we had a tremendous amount of imports that skewed the number negative, right? So I think this is kind of a catch up. We are probably really living in about a 2 to 2.5% economy right now, which is okay. So we have CPI that's coming in next Wednesday. I think that's going to come in probably 0.1, maybe 0.2, which will show a year over year of probably 2.7 or 2.8. Okay. And PCE sitting at 2.7, which will probably come in at 2.6. Again, we are back to 200 basis points, 2%, if you will, of restriction. The Fed, the policy rate, the upper bound of the policy rate is at 4.5%. We have inflation roughly about a little over 2.5. We have a slowing-ish economy. We have services that are neutral to slowing. We have the ADP number came out at only 37,000 jobs. So we have some things we need to look at, and I think it's time. In fact, one of my advisors this morning said time for the Fed to get in gear, and I couldn't agree with him more. I think a July rate cut is absolutely in order. I don't know that they'll do it, but I think it's absolutely in order. I don't know that it might be too early. A June cut would probably be too early. It could spook markets a little bit. Okay, it could maybe telegraph to the world, to the economy, that the Fed believes there's maybe an imminent recession. But I think a July rate cut, and then maybe another couple of rate cuts for the end of the year, is exactly what's warranted to get that upper bound, to get that policy rate within 100 basis points of where CPI and PCE will be at the end of this year. I don't think is out of the realm of unnecessary at all. I think the Fed needs to be proactive with this. If they don't, I think there could be they could be committing the same sins of 2021 and 2022, where they have to play catch up in a hurry. And that's, when they have to do that, when they have to basically take a flamethrower to monetary policy to get it to either expand or contract the economy, that's usually a very painful ride.
You don't want to repeat the same sins that you just recently committed. I mean, just as a general rule of thumb, it's hard enough to keep from committing fresh sins on a regular basis, right? You don't want to go back and play repeat of the things that you just screwed up. That's a little bit redundant. If you're going to sin or you're going to mess up something new in a fresh way. I like to be creative in the ways that I mess up in the future.
No, sure. But I mean, there's we can see, I mean, if you look at the housing market, right? 60% of U.S. counties now are reporting a contraction of housing prices. Okay. So,
A contraction? 60% are reporting a contraction?
Correct. 60% of U.S. housing, 60% of U.S. counties are reporting a contraction of housing prices. Okay. So again, and if you sort of hook that to the wagon of cooling ISM services, jobs cooling, the labor market really starting to cool, then it's not difficult to make a case of where parts of this economy could be headed. And if that becomes a problem, right? If you have declining housing prices and you have a cooling labor market, I mean, not that anyone's going to say this is going to turn into 2007, 2008, 2009 again, but that is the set of ingredients that caused that. Is you had elevated home prices, and then you had a labor market that just cratered, and you had a Fed who was absolutely sleeping drunk in the gutter and didn't move when they should have moved. Okay, and then what did they have to do? They had to slash rates to zero, and they had to bring in the TARP programs and do a bunch of quantitative easing, which could have been avoided had they just lowered rates and tried to keep the house, try to keep these things in place, but they didn't do it. Okay, so my hope now is that the Fed gets ahead of this thing and starts to neutralize their policy rate in order to, because if money's too expensive, you're going to see a reduction of capital expenditures, i.e. growing of the economy, hiring of new people, those kinds of things. And if people can't then go to their homes for, access to a certain amount of their wealth in case of a difficult time, that could compound the folly, which is again what happened during the Great Financial Crisis. So I don't think there's any chance of that. I mean, I'm not saying there's any chance. There's always more than a 0% chance, but I think it's an incredibly low chance of that taking place. But there are some things that I think should be paid attention to. But again, we look at objective optimism here. So
right.
There's a lot of things to be confident about. And again, so if you look at the Goldman Sachs GDP tracker for Q2 is at 3.3, and they're usually pretty conservative, right? So we're seeing a strong-ish economy. We're seeing a pretty strong economy. Nothing that's going to blow the cover off the ball here, but we're seeing some issues in the labor market side, and we're seeing some housing pricing issues. So I think that should be enough for the Fed to say, okay, I think we need to maybe lower rates, because if we don't, that could really get into earnings. That could really get into corporate earnings. That could get into layoffs. That could start a problem. I guess that could ring a bell that you can't unring. That takes a long time to fix, right?
Yeah.
So,
well, anytime we have this recency fear bias in a way, and you mentioned 07, 08, 09, and the Fed was kind of drunk in the gutter. In the post-COVID fiasco, it was I don't know if it's necessarily accurate to say we overcompensated in the opposite direction, but I mean the Fed was as aggressive as it could possibly be during the whole COVID mess to try to keep us out of the gutter and to keep the economy going, and probably overshot the target a little bit and overstimulated the economy, some could say, and that's where we ended up with the inflation problems in 21, 22. And now we're in this spot where the market's going to fear the sins of the past, if you will, and they're going to fear, okay, well, I think the market could be looking at now and saying, okay, we're at all-time highs or close to it. We've got this economy with a huge head of steam. We don't want the Fed to fall asleep at the wheel again like they did in 07, 08, 09. At the same time, the opposite side of that coin is we don't want to commit the same mistakes that we did in 21, 22 and overstimulate. So am I saying this or framing this in the right way? That it sounds to me that the bond market is a little bit more afraid of the 21, 22 mistakes, where the equity markets might be thinking back to like 07, 08, 09 and afraid that we're maybe ignoring not ignoring the it sounds like the equity market's a little bit more afraid of a collapse in the economy than it is runaway inflation right now. And you're saying objectively, the data says that's not where we're at.
Correct. So yeah, the equity markets are they're being although here we are at 6,000 again, which by the way we said market would get to 6,000 in June. Here we are at 6,000, first time since February 24th. So the equity markets are starting to look and see some light at the end of the tunnel. There has been some recent developments I think that are helpful. Okay, for instance, China this morning just released. There's a Reuters report. China released that China issues rare earth licenses to the top U.S. automakers, Ford, GM, and Stellantis. So that is kind of a prelude to a larger China trade deal, I think. And I think the equity markets really like that, and the bond markets like that. Okay, but the equity markets, they jumped this morning on this 139,000 job report, 139,000 new jobs created. Okay, because it was higher than consensus, right? But it wasn't so high where it was, it would raise, it was bad for yields, but then of course yields went up. So we saw the 10-year treasury go from basically 435 yesterday, it's at 448 today. So we saw a 13 basis point jump in the 10-year treasury note because of the jobs report. Although it wasn't a hot jobs report, because 139,000 jobs isn't that hot at all, it was just higher than consensus. So but if you look specifically at the equity markets, are they really buying it? I don't know, because if they were, I think the market would be at 6,200 right now. In fact, if you look at the AAII again, the American Association of Individual Investors, so your retail investors, right? Okay, it's still showing bearish. 41.4% of respondents are showing in the bear camp. 32.7 are showing in the bull camp. So we have about a 9% spread. Now, when that spread gets to be 20%, that's almost like a buy signal. That's so bad. So we're about halfway to a buy signal, if that makes sense. We've got nearly $8 sitting on the sidelines, waiting to pump into this market. So if this bomb I feel like we have two bombs being packed right now, right? Like the market is going to just absolutely explode and just go to 6,800, 7,000, or the market's just going to sit here and dwindle away and I would say cave in, but not really ignite itself. Okay. But if we have a Fed that starts to be proactive and cut rates, we get 3 rate cuts this year, maybe 4. The equity market, and we see the yield, that brings yields down, and that discount rate comes down, which it will. Okay. All of a sudden, that's going to be that's really good for equity markets. That's really good for risk assets. Okay. We know that if that interest rate comes down and those discount rates come down, okay, especially your higher multiple companies, your growth companies, those are just going to absolutely expand. So maybe that's why, and of course, if we have a good trade, if we have good trade negotiations that are taking place and good trade deals that are put into place from these negotiations, that that basically create more of a level playing field, that maybe brings more assets into the treasury that can keep a lid on yields as well. I think this could be an incredibly powerful time for this market, because if we have a long-term sustainable trade deal that's equitable for both the United States and China, and the United States and the Eurozone, United States and other countries like Japan, Canada, Mexico, I think that bodes really, really well in the long term. I think the equity markets will really glom onto that. And even as far as I'm doing my best trumpet, the big beautiful bill. Although I know there's a lot of talk about that.
The wonderful bill. It's a beautiful bill. It's a perfect bill.
No one's ever seen a bill like this. Right? And I know now Elon and Donald are at odds now because of the deficit. What could take place to, I guess, be the Donald Trump advocate here is the amount of receipts to the Treasury because of the tax cuts and the trade deals taking place and the expansion of the economy, i.e., could be enough to where it would keep a lid on those yields and keep interest rates down and be good for deficits and be good for debt. Because I I really believe that President Trump wants to keep deficits low as he can, and I think he's trying to accomplish it from obviously the Department of Government Efficiency, and as well as simply growing the economy. And when you do when you put something into place, being right may not be as easy as being proven right away, right away, right?
Yeah.
Sometimes it takes a minute. Okay.
Yeah.
And I think that's what this is. So, but back to let's go back to our lane here, the markets. Um, though the trade deals and jobs seem to be cooling, but not cold by any stretch of the imagination. Uh, the bond market, we're at 3.18 on high yield spreads. They seem to be okay with where the economy is. Goldman Sachs has a decent number for Q2. I think some of the bears are saying that the economy is going to grow by about 1% this year, 1.5%. I think we're at 2.3 to 2.6 economy, which is good, which is fair, which is normal. And I think we're feeling what we're seeing now is a real long-term normalization of interest rates and economic activity stemming from what took place during the pandemic.
Well, you and I were talking yesterday. This was somewhat enlightening, honestly, because we were talking about this. You've used the term melt up, I believe, is the way you've described what you kind of expect for the summer months. It's just a slow trickle to the 68, 6,900 levels, possibly. It's kind of polarizing. You said we can 62 or 68, probably not a whole lot in between. But I started talking about yesterday that we had the same. It kind of reminds me of 2017 in a way, and that 2017 was a super, super quiet year. The market was up 0.1%, up 25 basis points, down 7 basis points. A huge move in the markets was up 60 basis points in 2017. And it was really easy to fall asleep at the wheel and not recognize how much it was growing over time. It was like watching your grass grow or your beard grow. If you look at it every day, it didn't seem like it was doing a whole lot. You had to look at it from a bigger picture looking back to see what it had done. But 2017 at the end of the year was up like 32%, I think, for the entire year on the S&P. And that that's the best example that I can think of that melt up rally that you just don't really notice till you look back at the end of the year and say, my gosh, we're up 30% this year. How did that happen? And then we were talking yesterday, I thought, what does 2017 have in common with today? It was Trump's first year, right? 2016 was Trump running his mouth and all these things he were going to do. And the market was very volatile, waiting to see who was going to win the election. Trump wins it. And then 2017, it was bad news, bad news, bad news, except the market just went straight up. And that's kind of the same type of feel as what it sounds like you're describing as a best case scenario for this year. I know that's not necessarily your target case, but it's sort of your stars align just perfectly. That could be where we go, and it's kind of polarizing. But there are a lot of similarities. If for nothing else, there's that one major elephant in the room common denominator in Donald Trump.
Very true. I mean, if you look at early 2016, we had credit spreads almost hit 10, like 9.5% on high yield spreads. So there was a tremendous amount of anxiety in regards to the economy on the bond market side in early 2016 in the midst of the election. Okay. Then, of course, 2016 was a relatively mute year. I want to say the market went up about 9% that year. Okay. But there was a lot of consternation that year. Then, of course, Donald Trump got elected. And if you remember specifically to the night he got elected in 2016,
oh man,
crashing. They thought,
that was one of the nights of my career that stands out the absolute most. I was up till 3:00 in the morning typing an email to clients, waiting to chime in on the carnage. And then I got up a couple hours later, and the carnage was gone. The market had completely erased it.
Yeah, the market took off and just went to the races. It was great.
Yeah.
What happened is the market in that what happened is the bond market got absolutely slaughtered.
Yeah,
because we had very low interest rates back then. Okay, and of course the bond market saw it and said, wait a minute, this guy's going to grow the economy. He's going to cut taxes. That's going to send interest rates up, and that's exactly what happened. So the equity markets immediately saw what took place. Equities expanded, interest rates expanded, the whole thing. The tax cuts came in, and everything we thought was supposed to happen actually took place in 2017. And you're right, I remember that year very well. We could have just stayed home because I remember the VIX being like 9. There was
Oh, it
very
was
little, no
nuts.
one was buying protection. You wanted to buy protection. You didn't need to buy protection. Okay. But it came off of a very volatile 2016, okay, which I find very interesting. So, and again, what do we have here? We have not an identical setup. They're not twin setups, but I would call them siblings, right?
Sure.
We're coming off of, 2025 seems to be a pretty volatile year, okay, and there's this bill that generates some tax cuts, extends tax cuts, okay, and we have this tariff, the tariff trade deals are starting to, we're getting some clarity on those. So once a few of these big meatballs get sort of behind us, I think the market's going to see a lot clearer path. And back to the fund strat, where they said that one of the big reasons we had that correction in early April was that one of the covenants of capitalism was broke, and a stable regulatory environment, right? That's the covenants of capitalism is a stable regulatory environment. And you can't do, and obviously that was severely disrupted in March, late March, early April. So if that part, if that's basically fixed, right, and we have trade deals in place, and we have this big beautiful bill has been passed, whether you like it or you didn't like it or whose side you're on doesn't matter. As long as we know what is, that's the certainty the equity markets are going to need. And I can't think of in any way that the bond market will look at that as is any economically contractive, right? So I would think the bond market, specific to high yield spreads, would stay relatively tight, relatively healthy. Earnings will stay relatively strong, okay, and we'll continue to see that 10 to 15% annualized growth, and we'll tend to live in a multiple of 19 on the low end, probably 23 on the high end, okay, and it won't be all that smooth all the time. There'll be fits and starts and hiccups here and there, but I think for the most part, I think we have a 50-50 chance of either being 6,200 at the end of the year or 6,800 at the end of the year. It's just, we have this tale of two markets. And if the decider of which one we get, I think is Jay Powell. If the Fed gets on board that rates are too restrictive and they don't want to cause a long-term contraction in the labor markets, and they start cutting rates, that's what's going to take us. It's going to be the foundation that was built through the trade deals and the tax regulation and the earnings growth that's taking place over the next 2 years, coupled with a lower interest rate environment that will take us to that higher end, which I don't know if that's a good thing or a bad thing. I know it sounds weird to say that, but when you move that far that fast and you start living in the 22 times multiple for a long period of time, it just keeps that banjo string very, very, very tight. So when you get any sort of wiggle economically on the world, in a regulatory way, anything, you get 2 to 3 multiples cut off immediately. So on an S&P of $300 a share in 2026 and 335 in 2027, you get 3 multiple points cut off. You're talking about 1,000 S&P points. So
Well, I mean,
it's painful pretty quick.
And back to we've talked a lot the good girlfriend bad girlfriend analogy. It seems to pop back up around every couple of weeks or so. I mean, we've talked about 5% on the 10-year Treasury being the we don't want to go there. 4.75 gets us nervous. Right now we're sitting right around 4.5. What you're saying here? Would an additional rate cut beyond what was maybe expected, give us a little bit of a cushion to where we're maybe we get a 0.5% extra buffer there, where we're not living in this 4 to 4.75 range. Now we're living in this 3.5 to 4.25 range, and we're staying very comfortably clear of that 5% guardrail, and that kind of gives us the confidence we need to move the markets forward. And then maybe, and I get the banjo string side of on the flip side of that, if we live there too long, now you just start to get a little complacent as investors and you just think the market's always going to go up. And that's where you can see those catastrophic, collapses. But is that kind of what you're saying with the extra rate cut, is that it's just giving us that extra cushion between, so we're not getting so close to that 5% when things get a little gnarly?
Yeah. I mean, here's the thing is what's communicated on financial media all the time. Well, if the Fed needs to cut rates, they're telling you the economy's in trouble. No, they're not. It doesn't
Right.
have to be the economy's collapsing or the economy's overheating. They can simply bring it into a more of a neutral stance without accommodating the economy or restricting the economy, right? And the Fed cutting rates 3 times this year, bringing that upper bound to 375 or 350 or something like that, 3 or 4 cuts, says, okay, we have a strong economy, but I don't want to restrict it too much. Okay. But a little restriction doesn't hurt to make sure it doesn't fly away from us, right? We don't get entrenched inflation again. Okay. And it also signals to the bond markets like, okay, we think, the economy will stay relatively stable and not over and will not be overheating. Thus the bond markets, right, which is the secondary markets, which is where the 10-year treasuries and those guys live, which is at 4.5 today, will have room to come down, right? Because I think the bond market, I think the Fed takes signal from the bond market, but I also think the bond market takes signal from the Fed, right? And I, it's, again, those guys probably live in the same dorm too, right? So I think it's important that the Fed starts at some point normalize and neutralize. Okay, they shouldn't get there too fast, but it's not indicative of a weak economy. It's indicative of a neutral stance of a good economy. And I think the bond market will see that and say, okay, yeah, we can cut off a few. We have a little bit more room. We don't have to have we don't have to be selling off treasury. I think we have 100 basis points in 10-year treasury right now. It's at 4.5. I think it could be at 3.5 if we had a Fed that was a little bit more dovish and willing to cut a little bit more. And this very temporary setup we have where all of a sudden the U.S. treasuries aren't the safest place to be in the world because Donald Trump's the president. Okay, that's a big part of it. That to me is about 30, 40 basis points, just that. So you take those two things away, which I think will probably come away here by the end of the year. And I don't see why we wouldn't have a 3.5% 10-year treasury with a 375 upper bound on the policy rate with about a 2.5% economy. I think the equity markets will love that. Earnings will stay strong. And again, the S&P, the highest multiples for the S&P 500 lives when the 10 years between 3 and 5%. That's when we get the highest multiple on the markets, because higher than 5%, well, then we have too much competition from the bond markets because, well, hell, I can take no risk at all and get 5%, right?
Yeah.
And that starts to come out of the equities. But if it's below 3%, that's when the bond market's signaling to the economy and signaling to the equity markets, hey, we have a sluggish economy, and then the whole thing just kind of contracts a little bit. So, it needs to get into its happy place, and they all need to start orbiting each other a little bit closer.
Yeah, which we're in our happy place technically. It's just we keep flirting with our we keep we keep tap dancing around that 5% upper bound, which is that takes us out of that. We'd love to be, I mean, if 3 to 5 is ideal, we'd really have to stay around 4, right? That way we're not too hot, not too cold, but right there in the middle somewhere. And we've been kind of it took us a long time. It took us a decade plus to get back up to 3%. And then we kind of overshot it really quickly and shot from 3 through 5 really quick.
I would like the 10-year to live between 3.25 and about 3.75, and have a policy rate that's 50 basis points either side of that. I mean, I think it's, I mean, on it. Well, actually, I would like it, of course, lower than that. You don't want to have an inverted 10-year to 3-month rate, but
right.
If we have a 3.5% 10-year and a 3% policy rate and a 2.5% GDP, amen. That is a nice. That's yacht rock. That's a yacht rock economy.
Yeah, that's the. Have you seen the Good
Christopher Cross and Michael McDonald and a little bit of Steely Dan?
That's the unicorn on the Hot Crazy Matrix. Have you seen the Hot Crazy Matrix?
Not yet.
Oh my gosh, you've got to, like, as soon as you finish this, you got to take 7 minutes. Yeah, go on YouTube and just YouTube search Hot Crazy Matrix. It's a guy who basically he breaks down the guys are looking for girls that are somewhere on this axis of the hot. We can handle this much hotness and this much crazy.
Oh,
and where
yeah.
that lives. Yeah, that's a unicorn.
Yeah.
Yeah, that's a unicorn. And basically his premise is that there is no such thing as a less than 5 crazy, more than 10 hot, or more than 9 hot, something like that. You have to check it out. I can't do it justice, but there is this little zone there where he says this is a unicorn zone. This does not exist, but it would be perfect. If you find it, let us know, but we don't believe this really exists. So you have to check it out. It's worth 7 minutes of your time.
I really hope my incredibly beautiful and not crazy wife is not listening to this.
There you go. There you go. Surely you don't tell her about this show, do you?
What show?
Yeah, exactly. Well, as always, thank you for joining me, and for listeners, viewers, wherever, however you're consuming us, we are here for your entertainment and education purposes only. We're not here to tell you what to do with your money, but I do encourage you to reach out to Matt and his team at 702-655-8300, or just head over to to intelligentinvestment.com to learn more about ARPG and Matt and his brilliant team and all of the infinite wisdom hiding under that beautiful head of hair of his. And thank you for coming on here as always. Yeah, it's still looking solid today. I feel like I lost
clean shaven.
I lost a good 10 years.
You
I
look
think.
you look like a highway patrol supervisor. Like,
I
want to talk to your supervisor. You have no
that.
right to pull me over. You're the guy that would show up. Sergeant Lale.
I don't think that I can possibly say thank you to that. That cannot be a compliment, but I'll take it. I guess it's whatever it is. Oh man, good to see you as always, bud. See you next week. Same time.
See you next week.
Later.